Hi everyone, Lou Desepoli here, Heritage Financial Advisory Group. Wanted to take a few minutes with you and give you our fourth quarter portfolio strategy update, share with you a few ideas, cover some general topics, and of course you can always follow up with us directly if you have any questions. I wanted to focus on the economy, the markets, and then what we see going forward into the fourth quarter. So let's get right to it. As far as the economy, what we've seen for this year and what we see going forward are mostly positive things. The unemployment rate continues to go down. It's below 4%, actually about 3.7%. It's the lowest it's been in a very long time, and that's good for the overall economy. And with the unemployment, wages have gone up. People are making more money, companies are paying out more money, and so that is a good sign. But with that comes the possibility of wage inflation, meaning that since the employment pool is lower than it has been, employers may have to pay more money to get people to come and work for them. So that could add to wage inflation, which the market has to decide, if that's going to be bad enough to cause a little bit of a turn down in the market. But the overall sentiment in the economy is good. It's good by the individuals. It's good by the corporations. And when sentiment is high, usually that bodes well for economic conditions going forward. And of course, we have lower taxes this year overall for both individuals and corporations. We really won't know the full effect of that until people start filing taxes later next spring. But right now, there is more money in individuals' pockets, and generally that's going back into the economy. So the economy is doing well, the forecasts are good, companies are making money, and all of that will translate hopefully back into the market where we live. Now, as far as the markets, let's talk about that. Corporate profits continue to be at record levels. It's corporate profits that drive stock prices, which adds value to our portfolios. So with that, the fourth quarter earnings reports will be starting towards the end of October. We'll be in another earnings season, and we'll see how that affects the fourth quarter going through the end of December. Corporate guidance is good. A lot of companies are forecasting that their earnings will be good, will either meet or beat expectations, and when that happens, that's good for the overall financial markets in just about every category. Valuations still remain very reasonable. People have asked us, do you think the market's a little too expensive? Well, just because the markets are at a high doesn't mean they're too expensive. We look at fundamentals, we look at cash flow, we look at price earnings ratio, all the different things that go into determining whether companies are too expensive. And right now we don't see it. So don't confuse valuations with market tops and market highs. So the two can be very different. But we do see markets that are very fairly valued. A lot of people ask about the next turn down in the market or the next crash. We don't really see anything that would cause that at this point. There is normal volatility. That's been the theme for the whole year. We've emphasized volatility. We continue to see it, and we will continue to see it. It's not going away anytime soon. But there are some headwinds for the market. Let's talk about that. We have midterm elections coming up in about 4 weeks. That, leading up to the midterm elections and potentially afterwards, could add some uncertainty to the market right now in the form of volatility. We've had volatility over the last 2-3 weeks, and that's, I think, as we get closer to these midterms, you may see a little bit more of it. Interest rates. Again, that's been the topic for all of 2018. It's become more into focus right now. Interest rates have gone up. We had a rate increase a couple of weeks ago. We'll probably have at least one more before the end of this year, and possibly two. But what we see with the interest rates, and the market tends to react to it somewhat negatively, is that the interest rates increases have been slow and they have been steady. They've been increasing rates. The Federal Reserve has about 1/4 point at every increase. It's something that the economy can handle. They're not gapping up 1/2 point or more at one time. It's 1/4 point. It's slow and it's steady, and the economy's fundamentals are ones that can handle it. But what we have seen, and this has caused the volatility over the last couple of weeks, is that the 10-year Treasury bond is at its highest rate since 2011. It's approached 3.25%. So, that is a direct result of increasing interest rates. And when interest rates go up, there's volatility that comes back into the equity markets. Even though the interest rates are on the fixed income side, it comes back into the equity markets. So there is volatility, but as we say here in the office, volatility is like grapes. It comes in clusters. So, and sometimes you can't explain it. I can tell you that the technology index, or the NASDAQ, typically has a period of volatility once every year. They've been great performers. They've now been sold off a bit. Doesn't mean they're not good investments. It just means that other people will come in at an opportunity to buy and probably bid up the prices again. So we don't see it as a negative. We just see it as a normal occurrence. And volatility, along with interest rates, are part of our theme for 2018. So there's not always a reason for that, but we do see it. And we also have, as it's been in the news over most of this year, is the tariffs with China. We don't really have an agreement with China yet, but we've had tariffs on multiple occasions, and we will continue to follow that and see how it affects trade relationships with China and how it spills over into our financial markets. So there's a lot of different things here. We can talk for a very long time, but we appreciate the few minutes you're giving us. But as always, if you have any questions, feel free to email me, call me direct. Certainly we can meet too. We appreciate the opportunity to work with you. And if you know of anyone who has any questions or is not getting the service that they feel they should, give them our name and number. We'd be happy to talk to them about what we see and the process we do. But just remember, as we go through the investment cycles that we're in, we try to keep this as a non-emotional process. We don't want to get emotional about what we're doing. We let the data that we analyze and the quantitative data help us make decisions. But in the end, if we can keep the emotions out of it, we'll all be better off. So with that, hope you have a great day and a great quarter, and feel free to call us at any time. Thanks for tuning in.